Hello, my name is CJ Harrison and welcome to the Financial Success Academy. In this episode, I'll discuss the importance of having a long-term perspective when you invest and why the S&P 500 should not be your benchmark. The S&P 500 consists of 503 of the largest companies in the United States. It is extremely narrow in its scope and not what we or you should compare investment returns against. For example, our aggressive portfolio on your deferred comp platform includes over 12,000 stocks across 44 different countries. If you were trying to compare the two, it would simply not be an apples to apples comparison. We invest with the long term in mind. Historically, the S&P 500 and a globally diversified portfolio have provided virtually identical returns over longer periods of time. Over the past 35 years, the difference is only 0.5%, 10.9% versus 10.4%. We believe in achieving a similar long-term rate of return while taking on a fraction of the risk, rather than chasing returns, betting on a single index, sector, or company. In layman's terms, we want to invest with house odds, not single hands of blackjack. The long-term return expectations for the S&P 500 and a globally diversified portfolio are still both 10%. Being diversified means there will always be an asset class or a specific fund that outperforms a diversified portfolio. It is inevitable. In 2023, the winner was US large cap. In 2022, it was cash. In 2021, it was real estate. US small value, for example, has provided an annualized return of about 17.3% since 1975, but investing an entire portfolio in that singular asset class would be reckless. In comparison, the S&P 500 over that same period only returned 11.9%. The S&P 500 has had an incredible run over the last 14 years, but the 10 years prior tell a different story. From January of 2000 to December 31st of 2009, the S&P 500 had a negative 0.9% annualized return. Investors drawing down their portfolios during this time period faced significant losses and got absolutely crushed. In comparison, a globally diversified portfolio over the exact same time period would have returned an annualized return of approximately 7.4%. Understanding these principles helps us and will hopefully help you stay focused on your long-term goals and put yourself in the best position for success. I hope you have found this helpful, and as always, if you have questions, please give us a call. Stay safe and have a great day.